Good morning, everybody. I wanted to give everybody an update of what's happening in 2024, what we've seen year to date, and how we see this year progressing. I'm going to start with a couple things. First and foremost, I want to thank everybody for the past 27 years. We had our 27th anniversary last Sunday. I was very happy that during the years we've been very blessed to have a great group of people that we work with internally and externally, even the vendors that we work with as well too. So I just wanted to take a moment to thank everybody for that. It's something very special for me. So today we're going to go through a couple things. Just quickly, a brief overview of what happened in the first quarter of 2024, and then how we see that kind of progressing for the rest of the year. Now, this is inflation. Inflation is basically how more expensive things are getting. And if you take a look at 2022, we had a surge. Things were getting very, very expensive. Started coming down very nicely. And really what we saw is just kind of a little bump up going into March of last month. So I think what the Fed is saying is they're not sure whether or not the interest rates are working, how long they're going to have to sit on the sidelines with the interest rates where they are. It's going to be a wait and see type approach. But again, what we're seeing is that a lot of the interest rate increases have worked because it did bring down inflation, but it's not getting to where the Fed wants it to be, which is targeted at a 2% rate. So the next question is, what's causing this inflation? And the biggest area that we're seeing is housing. And there's a ripple effect through the world. So if you're a homeowner, you're a landlord, you're loving life right now because the prices have surged. But what's also happening is that there's a stalemate out there, meaning that if you're looking to upgrade your home, it's not possible because new homes are expensive and the cost of financing that are. But for the most part, a lot of areas of inflation have kind of calmed down. The biggest area that we're still concerned about is housing. So that's going to take a little bit more time. Now, when you look at inflation, you look at a couple different things. And the best way to think about this is if you went shopping in 2019 and you bought a couple bags worth of groceries for your family, how much would that cost you to feed your family? And that year, let's just say that number was $100. If we did that same shopping today, it would be 36% more. So basically another 36. So now it's costing you $136.50 to get the same groceries that you got a few years ago. That's a substantial increase. Some areas are even more expensive. You look at sports drinks and some other areas. So the bottom line is, especially for people that are at lower income levels, that food and just consumer goods are a big cost of what they're doing. That's taken a lot of their paycheck. That's basically around a 36% increase over the past couple of years. So the next thing, we're taking a look at inflation and basically what we see happening with the Fed and what they're doing with the rates. So again, just think of interest rates that the Fed is using as brakes on a car. And when they increase the rates, it kind of slows up the economy because the cost of doing business gets a lot more expensive. Now, when we hit the recession, basically back in 2008, rates went from 5%, a little bit more than 5% down to virtually zero, which they've been for a very long period of time. Now, there's some good things about that and bad things about that. Good thing about that is if you wanted to buy a home, you had interest rates, 30-year mortgages that were below 3%, which is terrific. The bad thing about that is that if you had money and you were retired and you wanted to get a 5% CD, these things didn't exist. And a lot of retirees are not in the stock market because they want to be. They're in the stock market because the interest rates that they used to get on CDs and money market accounts and bonds were just no longer there. But we're seeing that the rates have come up and they've peaked for a period of time. So the Fed stopped increasing the rates, and they're saying that we may get some declines later point during the year. And what a lot of people have been coming back and saying, and these are bets that I'm never going to take. A lot of times people are coming in my office and say, what's going to happen in the stock market over the next month? What's going to happen over the next 6 months? What's going to happen over the next year? I'm not looking at that. The biggest thing I'm saying is that reasonably you'll have a rise in rates. It'll plateau, and at some point in the future, it's going to start declining. What that tells me is that from a strategic standpoint, we should have longer duration bonds because longer duration bonds do very well in a declining interest rate environment. So I don't know if that's going to happen next month. I don't know if it's going to happen in 6 months, but I would tell you that within a period of time, a decent period of time, we're going to see the rates substantially lower than they are right now, and I'm counting on it. And that has an impact on a couple of different things. The biggest thing we just briefly talked about were the housing market. Now, the housing market, people just think about new home construction, but it's not just that. It's the lumber industry, it's the appliance industry, it's construction industry. There's real estate. All different types of things are kind of tied into this. And really, what we saw, the existing home prices change. I mean, we saw a spike that was crazy. And the average rate of a mortgage has increased from about 3% to about over 7%, which means that your cost of carrying a mortgage is substantially higher and it's pricing people out, especially on first-time homes. Now, existing home sales have fallen, but it's fallen simply because there's no inventory. You know, if you take a look at most of the towns that are out there, I'm not seeing any of the volume of homes for sale that we saw in the past. I think in my hometown there were 4. I mean, normally this time of year, you're probably seeing about 20. So there's not much inventory. There's a limited amount of people that have the money to buy these things. So you're seeing a decline in the sales, but that kind of makes sense. I mean, everything that we're seeing there makes sense. Now, how does this impact the stock market? Well, in the beginning of the year, the stock market was not looking too good. We had some decent declines in the first month, so I was getting a little nervous out there. But then we saw a very nice increase, and at the end of the first quarter, we saw increases around 10% for the S&P, a little bit less for the NASDAQ. Dow was probably around 6 percentage points, but we had a very good quarter. Now, one of the things I want to stress too is that during this quarter, there were 22 market highs, meaning that the index hit all-time highs out there. And a lot of times that does concern people. I'm going to spend a little bit more time on that a little bit farther down there. But overall, we had a great rate of return. Now, what I am very excited about is what we're getting now on fixed income. Now, again, there's some good things about this and some bad things about this. So the good stuff that I'm saying is that CDs are paying decent rates. Money market accounts are over 5%. Treasuries are over 5%. Now, what's supposed to happen in the bond market is the longer that you go out, the interest rate should rise, simply because there's a greater risk. Meaning that if you come in my office and you want to borrow $10, and you're going to give it back to me a week from now, reasonably, I'm going to get that money back. If you say I'm going to pay you back 5 years from now, there's a greater risk. Same thing with businesses and bonds. The longer the duration, there's a risk. And because of that, the interest rates have a tendency to rise. That's not happening right now. We're seeing longer term interest rates that are actually lower than the short term. But this is a double-edged sword. For those of you that are doing your tax return right now, we need to take a look at how much money we have in these cash alternatives and seeing how much taxable income that's generating for us. So one of the things I'm seeing is that, all right, great, we have a CD, we have $100,000 in that CD, paid us $5,000 or more. Great. Now taxes come. On that $5,000 income that we received, reasonably, we're going to have to pay between $2,000 and $3,000 of income tax on that income. So we need to be taking a look at your tax rate. We need to be taking a look at what are we doing with this cash and seeing, should we be looking at munis, which may be tax-free at a state level and a federal level? Should we be looking at treasuries that are state income tax exempt? Are there alternatives that work better for your specific tax bracket? One of the concerns that people have, and I just mentioned this before, we had 22 market highs in one quarter. So it's like the most ever. So we have that many market highs. Should we be getting out of the market? Should we be doing something a little different? And the answer is no. So we just took a look at returns after stock peaks, and we looked at a 1-year period of time, 3-year period of time, and a 5-year period of time. And for the most part, you're not really seeing any difference in the rates versus an average year. So just because you have a great first quarter doesn't mean that the rest of the year is going to be bad because you hit these market peaks. If we're looking at how history plays out, we're seeing that on a 3-year basis. Again, there's really no impact on a 5-year basis. There's no impact on the returns over that period of time. Now, one thing that I will always stress in our meetings is consistency. Whatever you do, if you want to be aggressive consistently. If you want to be conservative consistently. When you get in and out of strategies, it destroys your long-term performance. So here, what we're just doing is we're taking a look at one of the indexes that's out there, the Russell 3000, which is a smaller company index. And we're just saying, all right, if we had put in 25 years ago, $1,000, what would that be worth if we kept it in there over that period of time? And it'd be worth about $6,500. If you missed the best week, you would have lost over $1,000 of return, which is a very big increase in from a percentage standpoint. If you go out and you miss the best 6 months, And 6 months out of a 25-year period of time is a very low percentage that you're out of the market over 25 years. Your returns would have been about a third less. So the biggest thing that we're always going to talk about is protect your cash flow. When somebody is retired, I want to take a look at what do we have in Social Security? What do we have in pensions? What do we have in dividend income? What do we have in interest income? And what's the gap? And that gap is really critical because I want to make sure we structure the portfolio so that if we have some market volatility, I'm not changing our long-term investments. I think that is very critical, is that those investments need to stay consistent because we protected the cash flow. Now, if we have 100% of your money in stocks and the stock market tanks, the only option we have is to cut down the strategy and sell at a discount, which destroys performance. So again, if you miss the Russell 3000 best week, it shrinks to 5,300. Staying invested and focused on your long-term protects your long-term investments and gives you the ability to get reasonable rates of return over a period of time. So what's the outlook? Now, everybody's been coming into our meetings and they've been talking to me about the Magnificent Seven. And what I would tell you is that every other year, there's some terminology that comes out to describe the dogs of the Dow, or, all these different things that are new terms that some marketing person comes up with, says we should be investing in these securities. So if you take a look at the Magnificent Seven, and that was really Nvidia, Alphabet, Meta, Microsoft, Apple, Amazon, and Tesla. And we just took a look at their performance over the past couple, just really from January 23 through now. The top seven did 143% return, which is incredible. And in the first quarter, they were up 17%. If we just looked at the S&P 500, which has these funds in them, we had a 23% return for last year, which is terrific. And year to date, we're up basically around 9 percentage points. So again, people are saying, why don't we invest more in those things? And I'll kind of walk you through why not. So a couple things is that if you take a look at how stocks perform on the way up, and this is just getting to be, some of the bigger companies that are out there. If we're taking a look at the top 10 companies in terms of market cap in the United States, they have huge growth getting to that area. And if you take a look at those companies we just talked about, again, they just surged. And the growth before 10 years are averaging about 11% more than everybody else. 5 years, they're up 20%. 3 years before, it's just going through the roof. If you take a look at once they hit the top 10, what happens? We're seeing that their returns become flat. They become so big that it's hard to get those rates of return that they previously did. And the expectation that they're going to continue like this is very difficult. And that's what you're seeing with Tesla. That's what you're seeing with Apple and some of these big companies out there is can they continue to grow at the rates that they're doing? So now, I just want to stress this. I think Tesla is one of the most interesting companies that's out there. I know some people that work there. Anybody I know that has a Tesla car thinks it's one of the most amazing things in the world. If we take a look at the performance over a 10-year period of time, this is what we refer to as hockey stick growth, where it's flat for a very long period of time. And then all of a sudden it spikes to the roof. And Amazon was like that. Many of the companies you saw on this list were like this. So from then all of a sudden, 5 years ago, it surged from 2020 to now. I mean, it took a 2,000% increase in the value of the stock, which is an incredible rate of return. And if I look at that versus the S&P 500, it outperformed it tremendously. Now, again, in the past year, people are seeing this and they're saying, you know what, maybe I should be putting more money into Tesla. It's had such tremendous growth over this period of time. But what you're seeing is because of just the S&P, comparing the performance of the S&P, we're seeing Tesla having some of the issues that we were just talking about. And at the end of the year, it actually underperformed the S&P just because of declines in the stock. Now, let's take a look year to date. We take a look year to date, Tesla was down 40%, and the S&P was up right now at about 4.5%. So again, the biggest thing that we're going to be doing when we're looking at a portfolio is we're going to be rebalancing on a systematic basis. And what that does is it takes some of the gains that we have and move it in other areas. We're going to be using more funds that are more spread out as opposed to individual securities, because individual securities are hard to get out of when you have large tax gains. And we're just going to be doing things on a very structured and systematic basis. Over a period of time, the tortoise always wins. All right, so we had this great gain, 10% first quarter. More than that, everything is going terrific. What happens after that? How does the market generally perform after this level of an increase historically? And we're taking a look at any year since the 50s, really, that we had a 10% gain or better. And these are all the years on the left-hand side with a 10% or greater gain. For the next quarter, 82% of the time, they still had positive returns, and those positive returns averaged 5 percentage points. For the rest of the year, 91% of the time, the market still had very positive returns, averaging an 11% for the rest of the year. So the biggest thing that I'm always going to do is that I don't bet, because if I win $100 and then I lose $10 out of that 100, I'm just irritated. I'm going to have strategies that consistently I will win. So when I'm looking at these numbers and I'm saying 91% of the time, if I remain consistent in my approach, getting into what I was saying before, I will win. Those are the bets that I'm going to take on a regular basis, and I'm going to consistently stay in those investments and maybe rebalance them and so forth, just so I could get, keep the risk down. But again, the most important thing is that to remain consistent in your investments. Now, another question people have been asking us is, with inflation, how is that related to stock performance? Should I be worried with higher inflation? Is that going to hurt or help the stock market? And the only thing I would tell you is that they're really kind of uncorrelated. And the green here, you're seeing what the S&P did in terms of a real return. A real return is after inflation. You just take a look at what the index was. You subtract inflation, that was a real return. And the red dots are what the inflation was. So you're seeing 2008, when the market was down tremendously, inflation was flat. You're seeing 2022 when you had inflation and the market was down, and you're not seeing really any correlation between the two. Now, what I would tell you with inflation, the only thing that you could do is focusing on making more money. If you're employed, you have to see what you could do at work to get more money. If you're retired, can we be in investments such as money market accounts, CDs, some of the things that are generating income, which I think is very positive. In the reviews that we've been having, we've been taking a look at the bond performance. And again, the only way to outpace inflation is with additional income. And what we're seeing is that a couple of years ago, what the bonds were producing, and this is because interest rates were at 0, was maybe a quarter of a point. And now they're over 4, close to 5. So on $100,000 in bonds, your income went from $250 to over $5,000, which means, again, those are ways that we could get more income to you to help you deal with some of the inflation things that we got going on right now. And 22% of the past 30 years saw positive stock returns after adjusting for inflation. Inflation has flatlined. It hasn't gone away, and the Fed seems committed to making the target as 2%. So we need to take a look at what's going to happen over the next year. And again, at some point, maybe we'll have some rate cuts at the end of this year, possibly in 2024. I'm not really sure when, but soon. Second thing, interest rates are going to continue to impact the housing market. And that's a big part of the U.S. economy. I mentioned before, it's the construction industry, it's the appliance industry, it's the real estate industry. There's all sorts of ancillaries that are kind of tied in here, and there's a ripple effect through that. And people can no longer go into larger homes because they just outgrown it, because it's very difficult because of the increase in cost. Stock market's doing better than we had anticipated. It's doing very well, fueled by strong earnings and investor interest in AI-related stocks. Job market continues to do very well in spite of the Fed trying to slow down the economy. Consumer spending and unemployment benefits are all positive, but we keep on looking at this, and everything I'm seeing is pretty solid, all things being equal. And I would just say, expect the market to be relatively volatile for this year because of all these different things that we're seeing. I'm not seeing anything that would concern me so much that I would say I'm worried. I'm seeing things that I'm looking at on a very systematic basis. I'm talking to our stock analysts on a regular basis with OneDigital to see what their thoughts are, to try to come up with new ideas. We're implementing different strategies, let's say on the fixed income side, through muni bonds and other things that we could, even with the higher interest rates, get higher after-tax returns. So we're going to continue to do this. And once again, I just want to thank every one of you for the past 27 years. I can't believe it's been 27 years. It's been a blast. I look forward to meeting you at our next client review to take a look at your tax returns and really develop some more personalized strategies for you for 2024. Thanks again, and have a great day.